This video is for entertainment purposes only and is not financial advice. Hey guys, welcome back to another video. My name is Josh. In today's video, we'll take a look at Ryman Healthcare and their recent $902 million capital raise. We'll take a look at how the management team plans to turn the business around and also the impact of the share dilution on their future earnings as well, and we'll compare them with Somerset, which is a very close competitor. As always, none of this is financial advice, purely for entertainment purposes only. Let's get right into the video. So over here, I have a pie chart taken from the JLL Retirement Village White Paper 2022. You can see that Ryman is the largest retirement village and aged care operator. They have 19.4% market share of the national total by unit numbers. So they have the most units in New Zealand. The second largest operator is Somerset at 13%. This is from a unit perspective, so this is more like the retirement village business. And if you look at the aged care business, Ryman is also the largest. They have 34 villages with aged care. The second largest operator is Bupa at 31 villages providing care services. So from a portfolio perspective, Ryman is heavily into care. So let's talk about the offer recently and why they need to raise equity. So this was announced about 2 weeks ago on the 15th of February 2023, and they're raising $902 million. The purpose of the offer is to reset Ryman's capital structure, provide funds to strengthen its balance sheet through the repayment of debt, and better enable the company to execute its growth framework. Resetting this capital structure through new equity from this offer will allow Ryman to pay down debt by fully repaying Ryman's USPP notes. So these are interest-bearing liabilities, so something like bonds, and reduce pro forma gearing from 45.3% to 33.9%. The current gearing ratio is quite high at 45%. And that's bringing it down to 33%, which is more aligned to what the other operators are currently at. So the gearing ratios for Somerset, for Arvida, Oceania are, below 40%. In addition to this, the board has determined no further dividend will be paid for FY23, and with the steps announced, Ryman will be able to meet increased demand for the Ryman way of life, while also increasing cash flow generation and shareholder returns. Over here, I have an offer summary. So they're raising about $902 million. There's an institutional offer that's already taken place, and the retail offer, which these shares will be issued on the 14th of March 2023. So cumulatively, they're raising about $902 million, but the impact of the offer on their net debt will only be $754 million, right? So there's a difference between this number over here and this number over here, and that's the cost of the offer, basically. So the huge cost to investors, there's firstly the cost of raising the equity, and secondly, there's the cost of repaying the USPP early. So these are very explicit costs, very clear to us, but there's an implicit cost with raising equity, and that's the tax efficiency of paying out dividends, right? And then subsequently raising the capital back from investors. So I'll talk about that later, and there's also the dilution of EPS, which I'll touch on later as well. So the costs associated with full repayment of the USPP notes are currently estimated at approximately $134 million. So that's a lot of money that they have to spend just to repay those notes early. And other costs as well involves transaction costs of $30 million. So that's a cost paid to investment banks for helping out with this capital raise. The implicit cost that's not very obvious is the tax inefficiency, which I've mentioned earlier. So if you think about the dividends that were paid over the lifetime of Ryman being a listed company, they've paid over $1 billion in dividends. Now, if the average investor tax rate is about 30%, let's say, that means $300 million of tax is being paid out of the distribution. So investors don't receive $1 billion. They receive $700 million, right? After withholding tax has been deducted, right? So if you're raising $902 million comes from your pocket, right? So you've received $700 million in net dividends, but now you have to give back $900 million. So it's very tax inefficient. If they didn't pay out those dividends, then perhaps they wouldn't have to raise capital today. Another thing to note as well is that in the previous half year, Ryman introduced the dividend reinvestment plan, and they've also cut the dividend policy from 50% of underlying profit to 30 to 50%. So they've reduced the range, and they've also introduced a dividend reinvestment policy, and that tells me that they were trying to conserve cash. So this is a telltale sign of a business potentially needing more cash on the balance sheet, which could be helpful for you in case you have a company that pays a dividend. One day they introduce a dividend reinvestment plan. That's a sign that perhaps they're running out of cash. Something to look out for in your investment journey. So let's take a look at the outlook going forward. What's the strategy to turn the business around? Can they execute? And we'll look at the impact of dilution on guidance. So this slide over here shows what their strategy is. They're focusing on value creation and cash, focusing on new villages and premium locations, rebalancing the portfolio towards lower density townhouse style developments. That's something that Somerset has already been doing. They haven't actually focused much on apartments. If you look at Somerset's portfolio, they've built a lot in the regions where they can buy broad acre sites cheaply and build villas, low density type units. So they're following the Somerset strategy over here, introducing care suites to meet growing market expectations for premium care accommodation. So care suites, definitely a good way to increase your income compared to care beds, as there's a huge strain on care beds at the moment. Profitability of care beds is very bad. So this is a good way to increase your income by being able to charge a DMF on care suites. And right-sizing the care offering through decreasing proportion of care beds relative to retirement village units while still meeting the needs of Ryman residents. So that just basically tells us that care beds are unprofitable. Retirement village units are where you should be. And if you look at their ratio of care beds to retirement village units, that's gone from 0.55 to 0.35 from new sites from FY23 onwards. Just comparing them to Somerset though, this target ratio is still quite high. It's about 25% of their pipeline. But if you look at Somerset's pipeline, they only have roughly 3% of their portfolio building care beds. So overall, I think the new strategies make a lot of sense. They're following what Somerset has done well historically and adopting their approach. However, I do think that it won't be an immediate turnaround of the business. It will take some time for the new strategy to show in the results. So over here is the leadership team and when they joined Ryman. As you can see, the CEO joined in 2021. The CEO of Australia joined in 2021 as well. So they're relatively new to the industry. Well, at least for Richard Umbers. Cameron has previously worked in the aged care industry before. What you could do in your free time, if you are interested, you can check out their LinkedIn profiles, see what type of businesses they've previously worked in and whether those experiences can translate. So a new leadership team might take quite a few years to show in terms of the results. That's something to consider. Now let's take a look at the outlook, which I've highlighted over here, the underlying profit bit, and we'll take a look at how that would impact earnings per share based on how much dilution there is involved in the business. So over here is my spreadsheet where I calculate how much the earnings per share would be. So first of all, what I had to do was calculate the weighted number of shares outstanding based on the number of days they traded with, right? So this is how they normally calculate the weighted average shares outstanding in annual reports. So I've done that over here for FY23. It's 517 million. In FY24, the full impact of the capital raise will be felt. And that means that the shares outstanding is 687 million. So that's a 33% increase in the shares outstanding, right? Which is what we sort of expect with such a large equity raise. The net profit guidance that they've given us is $285 million. So that's in the middle of the 280 to 290 million range that they've provided. And I've increased that by 12.5%, which is also in the middle of the range that they've provided of 10 to 15% growth in FY24. So that means that FY24 net profit after tax should be about $320 million. What that means on an EPS basis is that earnings per share in FY23 is roughly 55 cents per share. But in FY24, that drops to 46 cents per share. So that's a decrease of 15%. They've also given us the net assets of 4.4 billion estimated after the whole capital raising. And that means a net tangible asset per share of $6.37 based on the number of shares outstanding in at the end of the year, which is 687. So based on the current share price today of $5.24 per share as of recording. This gives us a PE multiple for FY23 of 9.51 times and in FY24 of 12.24 times, and the price to NTA is 0.82 times as well. So they're currently trading below what the estimated NTA is based on my calculations. Now, if we compare them to Somerset, I've also done the same calculations based on the underlying profit that they've recently announced last Friday of 171 million and the current shares outstanding of 232 million. The PE multiple is 12.57 times and the price to NTA is 0.98 times. So as you can see, there is a slight discount Ryman is trading at compared to Somerset, even on FY24 PE multiples, which are slightly higher than FY23. So the discount between Ryman and Somerset makes sense because Ryman does have a portfolio that focuses more on care, which has more of a drag on earnings. We already know that because Ryman's strategy is to move away from building more care beds into more units, into more care suites. So a fundamental question to think about is whether that discount is big enough. If you think that this discount is big enough, then potentially Ryman is something to consider. Another thing I wanted to show you guys as well is how the current PE ratios that I've estimated compare to how they previously traded. So over the past year, you can see a contraction in the PE multiple. So previously they were about 16, 17 times. Now they're trading at, Somerset is trading at 12 times and Ryman's trading at 9.5 times. And if you look over the past 15 years for Ryman and Somerset since listing, you can see that the average PE ratio is roughly 20 times. So they're trading almost half. For Ryman, it's more than half. For Somerset, it's almost half of what they've previously averaged in terms of PE ratio. And that just reflects a lot of headwinds in the business. That reflects falling house prices, higher build cost, higher wages, lack of funding from the aged care perspective. I think a lot of those headwinds have already been reflected in the share price. So with this gap in valuation, I think Somerset is actually not much more expensive than Ryman, but you're already getting the more optimized portfolio. So from my perspective, at least in my portfolio, I do have shares in Somerset. I don't have any shares in Ryman. That's not to say that Ryman won't perform in the future. As I mentioned before, it's a new management team. They might be able to execute well, and if they do, then we will see a lot of upside. But at current prices, it does look like, Ryman is trading at a low. Ryman's PE ratio, forward PE ratio currently is at a low. Next year it'll be 11 times, so it'll be slightly higher than what it is trading right now. But overall, I still think that a lot of the headwinds have already been factored in. That being said, though, there might be a lot of drag from people that have exercise their rights to buy Ryman shares at $5 and then they might subsequently sell it above $5. So we might see a lot of pressure in the share price in the coming days for Ryman. At today's valuation, it doesn't seem very demanding. It is up to you to decide based on your research. So I'm just sharing with you my research. Hopefully this helps you out in your investment journey. As a disclosure, I do not have any shares in Ryman, but I do have some shares in Somerset. So that's my position on this whole situation. So overall, I think what Ryman is doing makes a lot of sense. They're resetting their balance sheet, resetting their strategy to follow what Somerset is currently already doing well. The question is whether or not you're willing to wait with Ryman to see how that transition turns out. As based on my personal experience, based on what Oceania was doing to reset their portfolio composition to focus less on care and more on units, I think it'll take many years to play out. And as you can see, the results for Oceania haven't been good over the past 6 years since listing. And so whether Ryman will follow the same case with Oceania could be the case, might not be the case, but that's a risk to consider. It might take many years for them to actually transition. But as an investor in the market, you can easily move in and out of your investments. So you could easily move from Ryman to Somerset very easily and already get the optimized portfolio immediately. So that's one of the benefits of being a small investor. So that's all from me for today. If you enjoyed today's video, be sure to hit like and subscribe. Thank you guys for watching. Until next time, take care.